Good afternoon, everybody, and welcome to our April set of webinars for the equities as well as fixed income. Today, we're going to start off with equities. For those who don't know me, my name is Jonathan Wu. I'm the Executive Director and Chief Investment Specialist here at Premium Asia Funds Management, and very, very happy to have both our PM and Deputy PM for our equity funds here with us today in Hong Kong. We have Renee Hung as well as Doris Ho. Renee is the portfolio manager and Doris is the deputy portfolio manager for both the Premium China as well as Premium Asia funds. Renee has been at Value Partners longer than the fund's existence. So Premium China's been around for over 17 years and the Asia fund has been around for more than 11 years. And Renee has been running the Asia equities fund day to day since the inception. So there's no overlap of other portfolio managers and their decision making. All the decision making for the strategy has been with Renee. So obviously, Renee, Doris, let's get straight into it because there's a lot of questions and a lot of things I think our investors and advisors want to have answers to, I guess, to their clients, and a lot has happened in China. So I guess first off, a lot of investors are quite worried about China, given the raft of government policies of late. Can you give us a balanced view of the risks and opportunities at the moment?
Yeah, thank you, Jonathan. And first of all, good afternoon, ladies and gentlemen. Thank you so much for your time today. And it's a pleasure to update you with our views on the ground. And yeah, I think, Jonathan, a lot of people also ask the same questions. And we have prepared a quick slide here to highlight some of the risk and some of the opportunities we see in the market. And of course, we believe that in 2022, we are better positioned compared to 2021. In a sense that, for example, especially the first point, I would say, common prosperity. I think for some of you follow China for quite a while, you are also aware or maybe remember the confusion first created globally when China government talked about common prosperity. To us, we think that the China policy on common prosperity is here to stay. And the reason for confusion is not anything wrong with the logic or anything else. The logic and the rationale is all fine, but it was just the communication and how they delivered the message was a little bit out of the blue to investors. But actually, if we study the policies throughout the past 5 years or even longer, we have seen many points that show that actually is pointing towards common prosperity. But people never use the term to talk about it. Basically, common prosperity is meaning that they try to narrow the diverging wealth distribution or maybe the income gap in China, and then also to promote competition and prevent monopolies in China. So in order to create a more sustainable economic growth and more harmonious society. So definitely, I think the rationale and the thesis for common prosperity is here to stay. But at least this year in 2022, we will have overcome the confusion stage or the surprising stage. So we expect that policies going forward will continue to conduct in this sense. And then, and what we see is that basically with all this foundation related to common prosperity policies, we still see opportunities in the market. For example, one of the things is that they want to improve the low birth rates in China. So basically in the past, they try to promote more free education and less tutoring to the population in China family, because maybe not very easy for one in the Western world to relate the tutoring fees versus low birth rates. But in fact, in a lot of Chinese families, they liked to put their kids into lots of tutoring services after school in summer holiday, created a lot of financial burden to Chinese families. So when young couples, they first get married and decide to have one child or two children, one thing would come to their mind is whether they can afford all these tutoring fees. So I mean, it goes down to very, very minute and details that these common prosperity is helping to shape the whole society. But then with this actually it also helps to promote more competition, and then more smaller players can become bigger players in different industry, for example, internet. And then at the end of the day, we can promote urbanization. We can promote more middle income class, and then helping to drive the consumption upgrade story, which we have been telling our investors. So this is something like, if you can see, actually all tied together and not something like a very surprising theme. So continuously going forward, we still believe that consumption upgrade is a very important thesis in the market for China investments. There are other, yeah.
I mean, if we sort of, another way that I like to reframe it, this common prosperity theme is really also down to the crux of how the Chinese government operates, and one of the benefits of their authoritarian type ruling system is that they can actually take the best parts of Western democracies and implant it in their economy, but it actually can't work vice versa. So one of the things that we've all seen globally in the last 10 years is that we've actually seen an increase in populist governments being elected in democratic states. If we then actually go to the crux of why that's occurring, is because people's wealth distribution in many Western democracies are effectively struggling, where the rich has gotten richer and the poor has fallen by the wayside. If we look at COVID as a great example, the wealth of the rich grew exponentially, and the wealth of the poor basically went nowhere, went backwards, especially those that live hand to foot, from hand to mouth. And so the Chinese government sees this, does not want to have, a populist type situation appear, which is the equivalent of social unrest in China. And so what they're trying to do is that they're trying to level the playing field, as Renee said, whether it be basically, dissolving after-school tutoring to give everyone a more equal hand and opportunity, whether it is to destroy monopolistic style, business practices to allow more competition. All of this is, and I remember Renee telling me this a couple of months earlier, it's effectively China inflicting severe short-term pain on itself, isn't it, in order to drive long-term sustainable growth.
Yeah, I agree 100% how you put it, the way from your point of view. Definitely is a painful time for them to adjust. But Chinese government is a fairly, I would say, young government with maybe a few 10 years of history, and the party itself actually only celebrated the 100-year pass last year. So basically, a lot of things are quite unique in a sense in China, and I believe that it's only in China, because of the backdrop of the ruling party and its government setup, allow them to be very pragmatic and very proactive to prevent these sort of, like you mentioned, potential long-term or along the road populist, or maybe income distribution problems, very effectively. And it was the right time to do so too, because if you look back about 2-3 years ago, China market has recovered very well, and property income was booming also in China. So it was a time that the government want to use to tackle all these long-term problems with some short-term pain. So definitely, we believe the most painful part of all these policies was last year, and then going forward, it was more of a smooth and continuous execution of this.
I mean, so China obviously had its major government meetings in March, as they usually do. I mean, what's sort of the key highlights that came out of that? Because I think one of the things that may have shocked the market a bit is, with GDP growth last year growing at 8%, and their target is now 5.5% for this year. I mean, it does that present opportunities or actually risks for investors, you think?
Yeah, I think, it's actually a lot of things were fairly on track until the COVID re-emerged in China in March, and I'll come to that. But like you say, the very important 2 meetings that took place in March every year actually reiterated the government stance in remember, like up till late, I mean last year, 2021, the government was quite using a lot of tightening measures to adjust the economy policies and all, liquidity, etc. But started in December, there was a definitely very clear signal, almost a U-turn in all these liquidity loosen policies, including, cutting the triple R, or maybe verbally talking about more measures to come out. We were expecting that more supportive measures would come out during the two sessions because we have the Chinese New Year in February, so and it was the end of the year, so they started with some selective policies here and there, but they were expecting that after people go back to work after Chinese New Year, and also after the formal announcements of the two sessions in March, they'll be very aggressively in having more pro-growth policies to come out. But unfortunately, we had the COVID started in the second, third week of March. So all these were put on hold because the key is to control the COVID for now. But if we look at what happened in first quarter, we saw the first quarter GDP growth number announced about 2 weeks ago was 4.8%. Actually, it was above the expectation of consensus, meaning that even though they started the U-turn of liquidity policies in December, it was actually very effective and very supportive through. So what happened is that we will continue to expect various city-based, very targeted loosening policies for the property-related market, and continuously monetary policy, and also fiscal infrastructure-related stimulus program, but definitely not in a sense like as crazy as what we've seen 10 years ago. But what I want to say is that the two sessions, originally when they came out, they had a GDP target growth of around 5.5% for this year, definitely too high because with the COVID. But I think COVID, we can see it as a one-off, and it will be likely to below 5%, depending how it evolves. But definitely the consensus have toned down, still reasonably decent growth. And then we are hoping to see that somewhat of a tapering situation in Shanghai and other cities, maybe towards the end of May. So that is our base case now for the COVID-related or maybe the economic policies that's stemming out from the two sessions meeting in March.
I mean, just talking about lockdowns and COVID, I mean, is the obviously markets have taken a bit of another dive this week in Hong Kong's, on the back of concerns that Beijing is about to go into lockdown. I mean, has that really changed anything for you guys as, long-term investors, or is it really, again, a case of, allows you to really trigger some buys in the market because there's some stocks that have now come down to such attractive valuations?
Yeah, I think for us, we always want to combine what we see on the ground, what's the valuation telling us in terms of expectation, and what is our medium to long-term horizon mindset for China investing or Asian investing. So for now, definitely for sure, global investors are very worried about the high inflation cycle and also the hawkish tone from the rate hike over the Western world, and also the potential, recessionary risk. And at the same time, the short-term factor is that the lockdown come from China this time. We are in the midst of it, but we believe that we are going to see we have already seen more or less the peak, or maybe peaking out, and then gradually the end of it. And then we have seen some effective policies in China to allow that the lockdown does not impact the manufacturing sector around the area too much. For example, allowing closed loop factories operations. We have talked to companies on the ground that they were closed down for maybe about a week, and then within a few days they were allowed, if they fulfill certain criteria, to resume about 30% plus of the production utilization, and then over like a week or so, more than a week, then they can recover about 70 to 80% of production utilization. So together with some of the inventory on hand, they hope to, slow down or maybe to mitigate the impact from the short-term lockdown impacting the earnings or the supply chain management of the whole ecosystem. But all this would play into some challenges into the sentiment. But again, for us, we check again with our thesis for the medium and long-term developments in China. We still have very strong conviction to it, and we believe that for people who have more strategic and long-term mindset, it is the current very interesting time to enter to the investing in, have exposure in this part of the world. Partly also because U.S. markets or Western markets also have their fair share of problems or issues, and the valuations on that side is actually more stretched. And we believe that there is a slide we also have in the deck, is that talking about the China-related market, we have very strong argument that, this one, thank you, Jonathan. If we look at the MSCI China, excluding Tencent, ADR, and A shares, and why we exclude these shares is because we look back to the index valuations back to 2006. So at that point of time, we don't have Tencent, ADR, A shares as large as a component of the index versus now. So we look at all these stocks, basically we are trading at dirt cheap valuations, mid-single digit. And where have we seen this sort of valuations before? So we believe the, I would say the chances or maybe the cards are on our side because all the negatives are factored in. So for long-term investors, we are very anxious to, to convey that we still have a lot of convictions along to some of the key investment themes that we have identified. But of course, short-term there would be some volatility, but we have sophisticated investors around the world who are very ready to put money to it. In fact, of course, there are some broker houses in the market that talks about a downgrade of GDP numbers here and there, challenges in the market. But Goldman actually came out 1 month ago when the market was had a huge meltdown, and then the next day recovered. I remember like 2,000 points. Basically, in that day that dropped, Goldman Sachs came out that saying that China is on sale, and then they say that yes, there are risks. But then everything has been factored in the risk premium. And according to Goldman's report, and in fact, it actually coincides with our own in-house report, saying that if we go back to even the 10 years lowest, mean valuations, we still see 20% upside from here if everything's go back to normal. So, I think, to answer your question, I think we cannot stress how much we see this is an opportunity if you are long-term investors. Yeah.
If we look at it from a sort of Australian advisor context, of which for those on the call that don't know my background, I'm still an advisor day to day, as well as here at Premium Asia Funds Management. Asset consultants, I think, of which I am one myself, are trying to work out whether or not now is a SAA decision to make towards Asian equities. And the rationale for that is that we don't know when the market's bottoming. We have no idea. It could be 3 months, it could be 6 months, right? We could have another range of lockdowns. That's not how we invest. But what we're trying to work out is that, okay, if we're going to make an SAA for the long term and not consider Asia as a TAA decision every now and again when we see that Asian growth is stronger, let's do a TAA there. Over a longer term SAA, not treating Asia as part of emerging markets, not treating Asia as part of the higher risk portfolio, but actually part of the core in which it should, have equal weightings against Australian equities or even global Western equities. And this is something that we've been advocating for a long time. Given the valuations that you see on screen, right, is this the right time to consider over the next couple of months to actually make that SAA call? And it's sort of setting it in place for a mindset that, over the next 10 years that you will, slowly increase and trim and cut, just like any other asset class that you consider as part of an SAA allocation. Because times like this, and if we consider, one of my other sales managers did mention this to me before, anecdotally, we can see that whenever the highest risk of lockdowns is imminent, or the potential threat of lockdowns is imminent, the market starts bottoming out. Right, and it creates sort of that bottom fishing exercise. And, the guys in Hong Kong are relative value managers, and they are looking at being disciplined at saying, okay, these are great companies, but these aren't great prices, and adjusting those valuations for whenever we have these, threatening events, that this is the time to evaluate that SAA tilt, as I mentioned earlier. So, one of the other sectors, I guess, Renee, that's on everyone's mind is Chinese property, right? We can't escape any webinar, any meeting that I have with advisors or asset consultants without talking about China property and the risks that, that is entailing from that sector. Can you sort of give us an idea of what's the current state of play?
Yeah. Especially after a very headline news that took place in 2021, including like one of the biggest property developer, Evergrande. They had a liquidity issue, and now they are under liquidations. And also a number of private developers in China also went through this very defaulted, very challenged situation. So how we see the situation is that I think deleveraging the financial system in China, and also including the property market, has been like one of the key targets for the past 10 years. And basically, we also see different perspective, including there is some important message there. One thing is that the Chinese government prefers to have market-driven mechanism to handle or allow them to for the property market to develop, meaning that there's no such thing as too big to fail kind of corporations. So when they set the 3 red lines to monitor the property developers, basically they also make a decision that if they are overgeared, if they are not healthy with certain requirements on the balance sheet, they are doomed to one way or the other fail. And that was what happened. It was better that they had this kind of tightening situation in a fairly decent economic market. Rather, say, for example, if this year we have another round of COVID, now we had another round of COVID, and economy was even further challenged, and these property companies go bust. Actually, it was much better that they inflict those situation or maybe default situation last year, because they were already on the verge of bankruptcy. So for us, we believe that it's good that the government is not like trying to boost liquidity into market to prevent failure of these troubled companies, and but at the same time, of course, they have created some situations that they need to tackle. For example, now for Evergrande, even though it's under liquidation process, they make it a point to ensure the projects continue to be able to deliver to the home buyers, including to allow these different, more healthier state-owned enterprises, property companies, or maybe other property companies who are willing to buy over the projects, and make sure that the money of the home buyers will finally get that the unit. And also at the same time, the whole supply chain, including construction materials that provide for the property development per market, will not suffer. Will continue to have business, not instead of having problem because one or a few property companies go default, they may also be dragged down. So this is still ongoing. But I have to say that if we look at the property volumes, which we monitor it on a weekly basis, or if not more, in various cities in China, we note that actually the demand is still very weak. In first quarter of 2022, basically the top 100 cities in China suffer a decline in volume of up to 47% on average. We believe it's more because of the economy. People are worried about how COVID, and also last year there were different challenges in the market that spill over to the economy situation. So people do not have the confidence to purchase the property units. We have seen many different, I think tens, if not hundreds of very loose supportive policies by cities, including loosen the mortgage approvals, but not to a very extreme extent, or maybe and then some selective loan mortgage rate cut in certain cities, etc., to support the local domestic market. But we have yet to see a recovery on the bottom-up level. With the COVID developed in March, we expect that maybe again, including this property data, will gradually recover in late May or maybe June. From that onward, we will go back to hopefully back on track to the supportive policies to reflect into the data, the economics data on the ground. But looking further down the road, we believe that state-owned enterprises, property companies, will definitely gain market share out of this whole issue of the default developers that took place in 2021. But this is okay too. I mean, state-owned enterprises, not state-owned enterprises, doesn't matter. A lot of the state-owned enterprises, property developer are of good qualities. And in fact, one of our top holdings for the two premium funds hold this some of the state-owned enterprises in property development space, for example, the China Resources Land, and they did fairly well in terms of share price even year to date. So I mean, over time we see opportunities even in such a bad property market. We started accumulating these state-owned enterprises a few months ago, and we made a good return for the clients. So again, I think it's a good example to show that we have challenges, but we also identify opportunities. Yeah, so hand over to you, Jonathan.
Sorry, I'm on mute. Sorry, my apologies. So if we sort of move away from China and sort of talk about the other regions in ex-China, sort of, do you want to talk through, what's the Taiwan situation?
Yeah. For Taiwan, I think from the geopolitical stand, there are maybe some news here and there between China and Taiwan and US, etc. And not only Taiwan, China, US, and even including like Ukraine, Russia, and US. So a lot of these situations give us a lot of thinking as well. Our ground and basis is that China and Taiwan will not go into a war, and that this is not what both governments want. Even if you ask people within Taiwan, they don't believe that there will be a war coming between China and Taiwan. So at least we will expect stability. At the same time, they go hand in hand. For the Taiwan economy, more than like a million, there were a couple of million people, actually Taiwanese, work in China, make a living, and there are like billions of dollars these Taiwanese corporates invest into China in the supply chain. So all these are continuing to go on going forward. The Taiwan market fundamentally are very interesting in a sense that they have a very important semiconductor supply chain. Globally, they are very important, including TSMC or maybe other smaller IC design companies. So Taiwan and Korea are very crucial, tech-related supply chain on a global space. So for Taiwan itself, definitely has a very strong cash flow from all these tech companies, and the dividend yield for the MSCI Taiwan is close to 4%. So of course, we have seen the very best of the semiconductor cycle in the past 2 years have ended. Last year, if some of you remembered, a lot of the IC component prices hiked 50%, 70% because of shortages, and then they were like orders were not able to fill because of shortages. The production capacity cannot catch up with the demand. So now this year we are seeing a more balanced. We have good demands globally. TSMC continue to deliver and continue to be the leader for a lot of these leading nodes in the foundry space. We also see that like demand from like data center servers to be have some growth this year. Of course, PC after 2 years of very strong work from home demand, actually PC is expected to come down this year, but within the PC, we also see opportunities in the commercial PC segment. Smartphones recently is a little bit challenging, but over the long term, we still see people continue to buy smartphone, and 5G upgrades are going to be there. So we are fairly, I would say, selective, but still we are comfortable with our exposure for Taiwanese companies. For Korea, yeah, please go ahead.
I mean, we have had some slight reduction in those exposures in TSMC and also Samsung Electronics, and probably, you know, maybe asking Doris to link it back to that investment theme. I mean, the prices, one of the, I guess the concerning facts is if I just look at, you know, TSMC's share price has sort of flattened out a bit, right? I mean, you know, Doris, is the thesis still there? I mean, okay, as Renee said, you know, IC chipsets gone up 50% or 70%. Share prices have sort of factored in a lot of that, I guess. Is it still investable? Is it still a good investment? Both, I guess, TSMC and Samsung.
Hello, Jonathan. Hello, everyone. This is Doris. And as Renee just mentioned, I think coming to 2022, the macro has changed a lot, and surely investors and also the people on the ground that we met, we all have similar concerns on inflation, on the end demand, weakening in the developed market, and then whether the consumer electronic demand has peaked out after 2 or 3 years of very strong growth. And so I must say we need to be, we have become more cautious and need to be more selective on picking stocks. For TSMC and Samsung, and actually for all these tech positions that remain in our portfolio, we need to make sure they are the winners and also the leaders in their own segment, and then can benefit from the long-term structural fast-growing demand in the upcoming application. So so that we can look beyond the normal cycle of consumer electronic, because obviously we see that a number of consumer electronic their end demand has either peaked or will be slowly weakening, I would say, in the coming 1 or 2 years, given all these macro concerns. But for TSMC and Samsung, they have been doing, we are confident that they have been doing very well in the fast-growing tech application. One example is the HPC, which is the high-performance computer. Because the upcoming technology we are all talking about is AR, AI, big data, machine learning, and all these in the future. We all know that these applications are going to evolve and to become more mainstream in our daily application. And behind all this, they all need HPC, the high performance computing, all these strong high-end computer to solve these complex problem, and all this will drive the underlying demand of high-end semiconductor, the data center, the upgrade in data center, network, etc. Because all those industries of semiconductor engineering, biotechnology, they all are gradually adopting these more high-end applications. So we can see that taking HPC market as example, we can see that Asia's tech leaders, they are gaining market share significantly in the past 5 years in this fast-growing sector. And in particular, for example, taking TSMC as example, is actually monopolizing the high-end market with over 90% market share. And if we take the most leading NOCs, the 3 nanometer nowadays, actually TSMC is the only one commercial viable vendor to their customers, to the key customers, including Intel, including Apple. And we see that this market, at this very high-end market, actually the market size will jump tenfold, and all these new order will go to TSMC. So we see that of course, coming to this year, all the tech sector names would go through a period of more volatility. But TSMC, we see that its investment 3 year, if we take a 2 to 3 year time horizon, its investment thesis is still very solid and trading at not demanding valuation at around 15 times PE, with a solid growth of teens to 20% in the coming 3 years. So that's why it's going to stay as our core holdings in our portfolio. And similar case goes to Samsung, but of course it's more diversified in terms of its component offering, the application.
Okay, excellent. So sort of going back, Renee, to, what's sort of our viewpoint, Korea, and then obviously India, and then ASEAN?
Yeah, I think all these countries are also facing the backdrop of a higher inflation challenges. But for Korea, we see that some good, points there. First of all, last year, Korea had a very challenging market. And some of you would know that Samsung Electronics is a key component, a major component for the Korean index. And last year, because of just their own fundamental reason, DRAM prices were were declining, so the profitability or the earnings cycle of the largest company in Korea is not actually very excited. But going to this year, basically we see that we have a lower base effect, and also secondly, we have cleared the uncertainty from the presidential election in March. So the current president, we are expected to be very pro-market, and he will come into office in about a month's time, and we expect that he will continuously roll out very supportive policies for Korea. And so I think that generally we are more optimistic cautiously for Korea in second half. For India as well, I think India, we always explained many times is that we are concerned on the valuations, but again, we are also more open in terms of looking for opportunities, especially after the market correction. But again, for India, commodity is not helpful. Basically, high commodity prices is not helpful to majority of the countries in Asia, except maybe Indonesia and Malaysia. But for India, we also want to see if we can benefit from this market correction, and then identify some maybe structural names at the right prices, because some of the sectors, for example, infrastructure, are still going to have multiple year of kind of catalysts and positive developments. So we want to be more open-minded at this point of time. But of course, also that we are aware of the risk there. For ASEAN, like I mentioned, because Indonesia and also Malaysia are strong in commodity, so lately they are benefiting from a stronger than expected commodity prices, and depending on how the inflation goes. And then secondly is that ASEAN recently have been opening up more in terms of after COVID. So if this continues, then we will see a gradually pickup in economic data. So we are also added some names in the past few weeks on some of the commodity related names in ASEAN, and then we are also looking at Indonesian financials companies, because within the financial sector in ASEAN, we believe Indonesia structurally would benefit more. Maybe some technology ideas in ASEAN, but again, yeah, we are looking around and then see whether we will have some increase in exposure there.
Interesting. So going back to sort of the other investment theme that I want to touch on, we made a very interesting observation, Doris, that that we haven't seen in the portfolios for a very long time is these what we call very traditional industrial stocks, things like China Mobile, and in the particular case, that we discussed would be an interesting thing to talk through is oil, which is CNOOC. I don't think we've held CNOOC or China Mobile or any of these sort of names for probably 10 years. And I think the last time I saw it was sort of at the start of the recovery post GFC, sort of mid 2009, we started holding these stocks again, but we haven't seen it since. And now all of a sudden they've sort of appeared. Can you sort of talk through why are we holding CNOOC all of a sudden?
Yeah, sure, Jonathan. You have a very good memory of our portfolio history, and you are correct that we haven't been these names haven't been the core, I would say, big positions in our portfolio for a long time. But in terms of our groundwork research, we never stopped. So in the past decade, our team would have continued our research on this sector, about the industry news and the company any changes in the company fundamental. We have a very regular update with the management, consultant, etc. Just like any other positions that appeared in our portfolio. So we know this sector evolvement and the company well enough. So once we see the opportunities come up, we can start to build position very timely. So and as you said, a number of these we can say traditional value stock have appeared again in our portfolio, but I would say it's more a result of our stock picking rather than any top-down allocation result of top-down allocation process. Taking CNOOC as example, we actually started to build our position since second half last year, because CNOOC, of course, the oil price has been staying very stagnant for a very long time until the political tension intensified in Ukraine earlier this year. But before that, we already noticed that CNOOC has become oversold last year after it has gone to the list of US sanctions. At one point, even the oil price was still as low as $15 US dollar. It's still at that oil price at that earnings, it's still such a low earnings. It's still trading at 5 times PE. So at that time, we start to think, what about oil price come back again? It would become 2 times, 3 times stock. And previously, CNOOC before the US sanction, it has always been trading at premium to other oil names in China, mostly because of its much better execution and very strong record of its management team. And that part of the company feature hasn't been changed for all these years. So we start to build a smaller position then. And then by the time the Ukraine military conflict intensified, we see that the oil price surge would become a very key catalyst to CNOOC. And at that time, we start to build a more meaningful position and has become our core holdings. So, so it's an example of demonstrating how we are actually doing still doing our stock picking, still doing our research work. So when the time comes for companies like CNOOC or China Mobile, because we see that they are trading at a much below the level of their intrinsic value, and there are positive catalysts coming, we can grab the opportunities immediately.
Yeah, I think it is a very interesting sort of point that you make, Doris, that it's not because you guys took a top-down approach and said, okay, we need to buy a whole bunch of traditional industrial stocks, but it's more of the fact that, okay, you've run thousands of models over all these companies and, you know, consistently updating them every time there is, you know, some meaningful change in fundamental values. And then now they just are within the valuation band to get in. And sort of, you know, for those that have been, you know, with us on this journey for a long time, especially with the Premium China Fund in 2009, you would have seen, you know, after allocations to these traditional value or I guess industrial stocks, after those allocations are made, because of the valuations are so low, everyone can see what the historical returns becomes. And that's why I always stress that we are relative value. We're not deep value, because deep value can come with other, you know, value traps, as many people have seen. Sort of moving on to portfolios, you know, obviously we're very, very proud of our track record, and our information and Sharpe ratios have been very, very strong. Obviously the last 12 months has been a bit of a setback. As you can see on the Premium Asia Fund, it's negative, you know, 16% for the last year. But, you know, over the medium to longer term, the performance does speak for itself against benchmark, against our peers. It's exceptionally strong, especially on information and Sharpe ratios. I guess, you know, looking at that positioning, sort of, you know, both Doris and Renee, if you could, you know, talk through the portfolio at the moment. You know, we still have a reasonable amount in IT companies, and, you know, are there not enough headwinds for you guys to question, especially around, you know, Tencent, and, you know, Tencent share prices obviously come off. You know, we've received questions about that. What's, you know, why are we still holding so much IT?
Oh, yes, Jonathan, thank you. I will talk about the Premium Asia Fund first. And the IT sector actually includes 2 major stocks. One is the TSMC and the other is the Samsung Electronics. In fact, the internet stocks, some of them has been categorized to consumer services and consumer discretionary. I believe Tencent is in discretionary, is it, or
communication.
In communications. Yeah, so basically IT stocks does not mean the internet stock, in the sense that so that's why it's a little bit, how to say, easy to confuse investors, but that's how MSCI try to categorize it. But for us, why we have this IT is, again, like we mentioned, that why we have this constructive view in TSMC and also Samsung Electronics. For the internet related, for example, like Tencent, Meituan, Alibaba. So I think some of the investors who follow us close enough is that they know we don't have we have very, very small or sometimes even no Alibaba exposure since the time when Ant Financial IPO was halted because of various fundamental reasons. For Tencent and Meituan, we believe that fundamentally they are still fairly, I would say, solid, but of course they have their own challenges because still, common prosperity or industry-related regulations will come over time. So, so definitely, even though we are more benchmark agnostic, we still have some exposure there because after all, we believe the management are very strong and they would help, they would be able to mitigate and still become the winner ultimately, but a much lower exposure than compared to maybe a few years ago. So so that is the reason why we have a fairly high exposure in IT, not because of the internet, but because of more of a hardware or the semiconductor chain, situation. And also we, as you can see from the top 10, we do have a fair exposure on China Mobile or China Telecom names. So also it is because that we believe these are fairly stable quality earnings with good visibility, which is what we like nowadays. And the company, like even China Mobile, is continuing doing share buyback. So that's why we believe it's a good portfolio anchor. For regional speaking, ASEAN, we still have some exposure to ASEAN, like I mentioned, because we like some of the commodity names there. But compared to the index, even though we are benchmark agnostic, we have a lower exposure than the index in terms of ASEAN. Taiwan, more or less equal, but again, it's driven by bottom-up ideas. Korea, we like it, but then we might slowly build up more position towards the middle or the second half of the year, as explained. And then otherwise, we have a mid-single-digit cash level maintained in the portfolio for normal, buy and sell, time frame. China A and Hong Kong, even though the challenges that we encountered year to date, we still believe that they will add alpha. I mean, our track record, like you say, pointed out, is that, of course, short term, they have some hiccup there, and actually was a major detractor for our 1 year and year to date performances. But we rigorously still look at the companies, whether they are very, whether they will benefit when things normalize. And we do believe that the names that are in the portfolio will. So that's why we are still very happy and comfortable keeping in those exposure there. Yeah.
Renee, the other thing is real estate. We note that it's now up to 7%. Obviously, China Resources is the biggest pick. Looking at just the PE of the real estate sector, it's like 4 times or something, right? I mean, that's historically ridiculously low. I mean, most people who have followed us for a while note that Chinese property has, at most traded about 10 times, which is still really cheap. I mean, that's a reasonable sized allocation now to real estate. Is the belief that it's basically, it can't really get much cheaper from here?
Yeah, I think for the real estate in the Asian portfolio is that it also includes some Asian name in ASEAN and Korea. It's in particular Korea too, because Korea, we believe that we will see some more supportive policies there, and there are some very bottom-up driven companies that we believe will benefit from the policies. So that's why we also added some of the China property. So see, in aggregate, it's a regional exposure to real estate. But like you say, yeah, I think valuations for, if in particular you ask Chinese property companies, the view is that we are seeing 2 segments. The private property companies in China, they are trading at 2 times, 3 times earnings, meaning that people don't think that the earnings are going to be real, or maybe they are going at the verge of bankruptcy. So for us, we also have a very cautious view there. But there are another segment that are trading at maybe mid-single digit PE ratio, which are the state-owned enterprises, property companies. We see that, for example, China Resources Land, which is the number 5 on the list, is one of the leading state-owned enterprise property company. And if we look at more mature market, including Hong Kong or elsewhere, mature property companies include a good portion of rental portfolio and a good portion of the developer business. So meaning that these earnings would be less cyclical due to the timing of the development kick in. So this company, yeah, like you say, usually should trade up to 10 times in normal times, but now they're only mid-single digit.
I mean, looking at that, you know, and we'll move on to the China fund because we have one question that's popped up, and please keep the questions coming if there are any. I mean, you're buying a portfolio and for the Asia fund that is, you know, consumer and IT focused in sort of the top 5 sectors here, and it's running at a forward 12-month PE of 10 times, right? Again, going back to this strategic asset allocation decision, something for everyone to consider there. With the China fund, obviously the correction and consolidation has been deeper, you know, negative 30% for the last 12 months. Sort of that's double the Asia fund. I mean, Renee, is there any sort of high level comments you want to say to that?
Yeah, definitely. Yeah, I want to comment on this too. I think for China A and market, even though China, of course, we have confidence on the medium and long-term view, especially from this point of time. But definitely in times of challenging when market that correction, China also has a little bit more volatility compared to regionally. So as a result, the China fund correction over the past year was higher than Asian fund. I think this is a fairly logical expectation as well. But I hope to also see when the market rebounds, China fund would also rebound more. But of course, it depends on the volatility appetite for the investors too. Yeah.
Yep. And then I guess with the China fund, there seems to be more of a balanced in, you know, sector allocations compared to the Asia fund, where it seems to be more IT heavy. Do you want to sort of talk to that?
Yeah, one thing I want to highlight is the IT or the tech or semiconductor cycle in China is a little bit different from regionally. In China, it's actually much less developed, I would say more behind, estimated easily 5 to 7 years behind Taiwanese, US counterparts. So that's why we don't expect as much IT exposure in China-related fund. Of course, Chinese government is promoting more investments, more subsidy into tech sector to catch up. But a lot of them are yet to be profitable, and then also technology is still catching up. So that's why in China, we are more excited on the consumption upgrade or maybe other opportunities.
Yep. And you can see the portfolio, the PE for Premium China is actually 8.4 times. So obviously, you know, very, very attractive there. I also note there's a lot more consumer names in the top 10, Renee and Doris. I mean, we've got China Mingyu, we've got Anta Sports, and also, I guess, a consumer stock to a certain extent, but its private wealth is our largest holding is China Merchants Bank. So, you know, we're really catering to that, the private wealth thing there, I guess.
Yeah, you're right, Jonathan. And we continue to see that consumer upgrade would be one of the key themes for our investing in China in long run, because of those policy support and I would say the consumer appetite upgrade coming with the increase in income and wealth. So you can see within consumption and to a certain extent, China merchant banks representing the retail banking and the demand on wealth management of Chinese household. You can see the names would concentrated on companies that we think in long run would gain share in the higher end and more I would say more capable to cater to the consumer taste and preference evolvement. Taking Mengniu as an example, Mengniu is one of the 2 leaders of the dairy names in China, and it's been gaining market share in China since the food safety scandal 10 years ago. And recently, after the pandemic, we see that from those research reports, Chinese consumer, over 90% are willing to pay premium for healthier food and services. And we see that Mengniu is obviously benefiting from this trend, and its management has a very strong track record to delivering the right product and then building the right image to engage with the consumers. So that's why we see that Mengniu is going to stay as our core holdings in the portfolio now and then, and I would say beyond 2 or 3 years.
Okay. I guess just in the interest of time, sort of 1 minute answer, there's one question here asking, when will China pivot away from COVID zero? Can they even get near to 5.5% GDP if they don't?
Yeah, first of all, I can answer this. For 5.5, yeah, I think the consensus is it would be definitely below 5%, very likely, at least for now. Maybe next year we'll see how it goes, but this year I don't think we have high hopes on that. For COVID zero, seems like there are increasing a little bit more discussion on it, because especially the symptoms for Omicron is much less than before. But I think in a lot of people should understand, in China, the reason why they have to stick to the COVID zero is because in some second, third, fourth tier cities or village, basically they only have 1 or 2 doctors every 1,000 people. So basically, if they don't stick to this COVID policy previously, many people, millions of people would die. So I think that was the rationale why they had to have this policy. But I cannot say when they would stay away from this policy, but over time we are seeing a little bit more discussion. So we need to monitor, yeah.
Yep. Okay, excellent. There's no other questions that's come through. Thank you everyone for your attention this afternoon. And of course, as always, please feel free to reach out to myself or Derek on the details that you see on the screen. For our friends in New Zealand, I look forward to seeing you all next week. It'll be my first international flight in 2 years and 2 months, I guess. So with my last international trip actually presenting in New Zealand of March of 2020. So I look forward to seeing a lot of you next week in the various cities that I'll be visiting. And then also for those of you in Melbourne, I will be visiting in June. And so I'll reach out for catch-ups with a lot of you then as well. So with that, Doris and Renee, thank you very much for your time. Tomorrow, same time, 12 p.m., we'll have our update with Gordon Ip, who's the Chief Investment Officer of the Fixed Income team and the PM to the Premium Asia Income Fund. We'll spend a lot more time talking about property then as well, to give you a bit more of a deep dive. But until then, I wish everyone a great afternoon. Thank you.
Thank you.